Teladoc reported earnings. The stock's down 40 or 50% after hours. It's down something like 90% over the last, 6 months or a year. Has just been a complete disaster. Teladoc is ARK's third largest position across their entire fund. I don't own Teladoc. I do own Tesla. This, for me, potentially brings into question ARK's legitimacy and their research legitimacy. When somebody is so wrong, and not just about, a one-time position or a one-time buy. We all make those mistakes. But when somebody's so wrong on a large position that they've been buying and adding to so much over the last, several years, it just makes you doubt the decision-making, the portfolio management, the research. And I'm not trying to be hard on ARK and Cathie Wood. They're taking a lot of heat, and I think they've done amazing things. I think I land at the fact that, the research done for Teladoc and the research done for Tesla on ARK's part are different buckets, different styles, probably different analysts involved. And maybe the lesson is that it's hard to be specialized and be really good in investing in such different diverse areas, healthcare versus technology, innovation, EVs. Maybe that's a skill that ARK has really honed, the Tesla side. And they spent so much time on it. And they expanded into different areas and got overconfident in other ways because of the results of Tesla, and then getting more interest from investors and more money and having to grow these funds and grow into more funds. They've expanded the amount of funds that they have in their umbrella over the last couple of years. And so maybe that's more the lesson here with Teladoc, is that for us as individual investors, or maybe we're invested in ETFs or funds, and so it's how we think about what ETFs we invest in. We just have to be careful about getting overconfident, about letting the success of one bit of our research about a certain type of company bleed into thinking that we can apply that to different industries and different companies and spread ourselves too thin. And also it's a lesson on, in my opinion, there's arguments on should you diversify or should you have a concentrated portfolio. The best investors in the world and the richest investors in the world generally have gotten there from big concentrated bets. But we're talking about, less than probably 0.1% of all investors that have had success that way. And my guess would be that there's far more failures from over-concentration than there are massive successes. And so for me, I don't think I'm smart enough or a good enough investor to bet, put all my eggs in one single basket or just a couple baskets. Because we see some of the smartest, most respected people in the world, even Charlie Munger with Alibaba has made a huge mistake. Monish Pabrai, who's a legendary investor, has made a huge mistake with Alibaba. And Cathie Wood and ARK, who I have a lot of respect for, have made huge mistakes in Teladoc and Peloton and these other companies. I've made huge mistakes. And the benefit that we have as individual investors is we don't have people investing in our funds or anything like that. And there's no pressure to have excessively large positions. And so that's my takeaway is let's be realistic with who we are, not get overconfident, and just be careful who we're following because everybody makes mistakes and everybody gets things wrong. Real quick, this is CathieWoodStocks.com. I don't know exactly how accurate it is. I trust that is relatively accurate, but we see Tesla across their funds is about 10% of all of their holdings. Zoom, 7%. Teladoc, 6%. So right up there, number 3. And then the next are Roku, Coinbase. Here's Teladoc over the last year, down 70%. That does not include today. It's down 47%. The market just opened. It's down 47%. Stock's trading 43% lower after the telehealth company missed street forecasts for its first quarter 2022 revenue, prompting many analysts to downgrade the stock. Financials reveal cracks in Teladoc's whole health foundation as increased competitive intensity is weighing on growth and margins, says Citi analyst. Issues were particularly notable in the company's fastest growing direct-to-consumer mental health and chronic care segments, which according to the analysts were expected to drive growth over the next 3 years. It's really just a reminder and a warning to myself, to others, not trying to pick on anybody, and especially not Kathy Wood and ARK. We just have to be careful out there and be thoughtful about who we're following, doing our own research. And then I guess the question is Teladoc has sold off so much. Am I considering it for my own portfolio? The answer is no. It's a complicated story. It could be a major, major winner from here. I don't know. But I realize we talked about skill sets earlier and time that we have. I don't think I'm a good turnaround investor and rebound investor and, special situation type investor. I like to look for companies that are executing well, have a long-term growth trajectory and good opportunity in the market, and that aren't showing signs of weakness. When they start showing cracks and signs of weakness, a lesson from this saga and even Peloton and even Zoom when it was trading at crazy valuation is once that weakness starts to roll over and it starts to show and the business is starting to stumble a little bit, maybe we don't double down and step in and try to recoup our losses or whatever, and we invest in strength and execution. And that's not meaning that we're momentum traders and day traders or anything like that. It's just we want to own great companies, and if that story starts to change, the execution starts to falter a little bit for maybe 2 quarters, it's time to really start to reconsider our position. If people owned Teladoc and did that when their struggles first started and they first started missing estimates, starting in first quarter of 2020, they missed on earnings. They missed on earnings again 3, 4, 5, 6 times in a row, 6 quarters in a row, Teladoc missed on earnings. So if we go back to around March of 2020 and look at, Teladoc was trading at $123 a share in March of 2020. And so, the stock even went up as they continued to miss. And so even after that, like the next quarter they missed, it was at 237. That was like craziness in the market. So it's obviously easy in hindsight, but that's what I'm trying to do is like learn these lessons. That's now 2 quarters of missed earnings, and that's them missing probably analyst expectations, but also maybe management guidance. I haven't looked exactly. Since then, the stock has just continued to fall, and there's this never sell mentality. I don't want to sell. I want to own my companies as long as possible. But sometimes the story changes. The thesis changes. We lose faith in management, not just for 1 quarter, but for multiple quarters. And this is how I'm evolving as an investor. When that starts to happen, we need to reconsider our position. Has the thesis broken? Not just about the stock price, but about the company and their execution and management's ability. That's my takeaway from Teladoc. Hope this was helpful. Subscribe to the channel, like the video. It really helps me out. Love it. Thanks.